Adjusted income begins on or about page 77. Adjusted income means annual income of the members of the family residing or intending to reside in the dwelling unit after deductions. In other words, annual income minus deductions will give us an adjusted annual income figure. In our calculation, we first take gross income, subtract out the income exclusions to get annual income. Next, we take the family's annual income, subtract out the deductions to derive at an adjusted annual income figure. There are 5 mandatory deductions, which include $480 per dependent deduction, $400 elderly or disabled family deduction, medical expenses, disability assistance expenses, and child care expenses. We will be discussing each one independently. The dependent deduction is a $480 allowance for each dependent. The Code of Federal Regulations defines a dependent as a member of the family except for foster children and foster adults other than the family head of household or spouse who is under 18 years of age, a person with a disability, or a full-time student. As housing authorities, we do not use the IRS definition of a dependent. HUD's definition must be used. A dependent is anyone in the household who's under 18, a person with disabilities 18 years of age or older, or a full-time student. The family will receive a $480 allowance for each dependent in the household. Remember, the head, spouse, co-head, live-in aides, and foster individuals are never considered a dependent. In my hypothetical family, I'm the head of household and I'm married to a 17-year-old gentleman. We have a 1-year-old child. How many dependents do I have? Only one. My spouse is not a dependent even though he is under the age of 18. He's not a dependent because a spouse can never be a dependent. The second deduction is a $400 allowance for any elderly or disabled family. HUD gives us the definition of what an elderly family is and a disabled family under CFR 5.403. An elderly family is where the head, spouse, or sole member is 62 years of age or older. A disabled family is where the head, spouse, or sole member is a person with disabilities. As long as the head or spouse is 62 years of age or older, or is a person with disabilities, the family qualifies for a $400 family allowance. This is not a $400 allowance for each elderly person or person with disabilities. It is $400 for the family as long as the family qualifies as an elderly or disabled family. So I'm no longer with my young husband. I went to the next extreme. My new husband is 65 years old. I still have my minor child with me, and my husband's son is also living with us. He is 25 years old and is a full-time student. So my new household is myself, I'm the head of household, my 65-year-old husband, my minor child, and my stepson who is a full-time student. How many dependents do I have? 2. The full-time student and the minor child. Does my family qualify for the $400 allowance? Yes, because the spouse is elderly and qualifies us as an elderly family. Our next deduction is medical expenses. The medical expense deduction is permitted for elderly and disabled families only. If the family's head of household or spouse is 62 years of age or older, or is a person with disabilities, the entire family qualifies for this deduction. Think about this. If the family qualifies for the $400 allowance, they also qualify for medical expenses. The allowable unreimbursed medical expenses is to the extent that the sum exceeds 3% of the annual income. For example, this family has medical expenses of $3,800. 3% of the total annual income for this family is $525. Therefore, the allowable deduction would be $3,275. If there is an elderly or disabled family, medical expenses are provided for each member of the household, regardless of age or disability. However, live-in aides and foster individuals are not assisted household members and cannot qualify for any deductions. Medical expenses include, but are not limited to, services of doctors or other healthcare professionals. You have medical insurance premiums, which includes Medicare. We also have transportation to treatment. We can also allow as a medical expense dental, eyeglasses, hearing aids, batteries, and so on. Medical expenses also include any monthly payments on accumulated medical bills. With unpaid medical bills, we have to verify how much will be paid over the next 12 months. Let's say you have a participant with a $4,000 unpaid hospital bill. He plans on paying $100 per month toward the bill. We would only include as a deduction $1,200, which is $100 times 12 months. Medical expenses also include prescription and non-prescription medicines. With your non-prescribed medicines, your housing authority will have to determine if, first of all, non-prescription medicines are acceptable, and second, do over-the-counter medicines require a doctor's prescription. All PHAs are responsible for establishing policies for allowable medical expenses. Most housing authorities use the IRS publication 502 as their guidance. Your medical expenses, including medical insurance premiums, are anticipated during the period for which annual income is computed and that are not covered by insurance. In other words, we're anticipating how much is going to be paid over the next 12-month period of time. This brings us up to our next walkthrough exercise for Jenny. Jenny has 2 children under 18. Her spouse is disabled. The anticipated medical expenses for the family are $2,500 per year. The family's annual income is $17,000. Not only are we going to calculate Jenny's expenses as a group, but I also want to go over this part of the 50058. We will be using the 50058 on the opposite page. On Part 8 of the 50058, this is the expected income per year. We begin with line 8A. As you notice, it tells us total annual income. Copy from 7I. Well, because we don't have a 7I, we're going to go ahead and use the $17,000 that we show in your books as what Jenny's annual income is. So on line 8A, go ahead and write in there $17,000. Next, you're going to see a bold area that says permissible deductions, public housing only. Lines 8B through 8E, this is for public housing only. They have a 6th optional deduction that we don't use in the Housing Choice Voucher program. For the purposes of this class, we will not be calculating any permissive deductions. So fields 8B through 8E will not be used. Do whatever you have to, mark it out, put X's there. We're not going to be using this field. We're always going to skip down to the next bold area. And our next bold area says, if head, spouse, co-head is under 62 and no family member is disabled, skip to 8Q. Well, everyone in the family is under the age of 62. The head and spouse are under 62. However, remember, Jenny's husband, he is a person with disabilities. So we're not going to skip anywhere. We're going to go right to line 8F. 8F is our medical disability threshold. The form tells us to multiply 8A times 0.03. So go ahead and take 17,000 times 0.03. On line 8F, you should have an answer of $510. What we just did is we just calculated 3% of the family's total annual income. Because remember what we learned, for medical expenses, we're only going to allow any unreimbursed medical expenses that exceed 3% of the total annual income. The next field on line 8G, if you notice, it says total annual unreimbursed disability assistance expenses. Now, I'm going to give you a hint. We haven't even talked disability expenses yet, so we're not going to have any in this calculation. So normally we would skip over this area and go right down to 8K. However, before we skip over, I want to point out 8H. When you look at 8H, there are 3 separate fields. Whenever you have more than one field for the identical number and letter, as in 8H, you're only going to have one answer in one of those 3 fields. So if you notice on 8H, the first line, maximum disability allowance, if 8G minus 8F is positive or 0, put the amount. So when we do start calculating disability expenses, we're always going to take 8G and subtract out the amount on line 8F. If it's a positive, you use the first field on line 8H. If it's a negative, you'll use either the second or third field on 8H, whichever applies to that family. But you'll get an opportunity to calculate one of those in a little bit. Let's go ahead and skip down to 8K like the form told us to. So if you focus your eyes down on 8K, this is our total annual unreimbursed medical expenses. And what is the family's medical expenses? $2,500. So on line 8K, go ahead and write in that amount of $2,500. On 8M, this tells us total annual disability assistance and medical expenses. But look at the 5058. It tells us to take 8J plus 8K. Well, in 8J, we have a blank field. 8K is $2,500. So what would 8M be? $2,500. Next we have 8N. And if you notice on 8N we have another one of those split fields. We have 2 fields and both of them specify 8N. So we're only going to use one. When we look at the first field, if no disability assistance expenses, or if 8G is less than 8F, put 8M minus 8F. You're probably thinking, what? Can you kind of repeat that again for me? What I like to do is I like to break it up. So let's read the first part again. If no disability assistance expenses, and stop right there. Do we have disability expenses? No. And because that next word is or, that means that either one of these statements just has to be true for us to use this field. So because we have no disability assistance expenses, we're going to use the first field on line 8N. And it tells us to put 8M minus 8F. So we look at 8M, $2,500, subtract out $510 from line 8F. Your answer on 8N, you should have gotten an answer of $1,990. We have our answer on line 8N, so you don't even have to do anything with the second field on line 8N. We're going to skip right down to 8P. This is our elderly disability household allowance. Because Jenny's husband is disabled, he qualifies the family as a disabled family and they get that $400 allowance. So on 8P, write $400. On 8Q, this is the number of dependents, and you notice the 5058 form even gives us what the definition of a dependent is. Well, Jenny has 2 children under the age of 18, so on 8Q we have 2 dependents. The next field, 8R, all this is just a default. All we're going to put on 8R is $480. Think about it this way. HUD wants to know, well, what is the dependent deduction? Well, it's $480 per dependent. So on 8R, we're going to write in $480 because we're going to calculate that allowance on the next line. When you go to 8S and look at the dependent allowance, the form tells us to take 8Q times 8R. 2 times $480 will give us a dependent allowance of $960. 8T is our child care costs. We have no child care costs. On 8X, when you look at the total allowances, the 50058 form tells us to add lines 8E plus 8N plus 8P plus 8S plus 8T. What I like to do is I like to put a little check mark next to each one of these fields. That way, when I go back and add up the total allowances, my eyes can focus just on that field. So go ahead and add up the total allowances for Jenny's family. On 8X, your total allowances, you should have come up with an answer of $3,350. Next, on 8Y, it's time to calculate the adjusted annual income. The form tells us to take 8A minus 8X. Go ahead and calculate your adjusted annual income. On 8Y, the adjusted annual income, we should have an answer of $13,650. HUD issued a PIH notice in December 2005, providing guidance on income and verification regarding the Medicare Prescription Drug Plan. This notice is in your book for your reference beginning on or about page 80. It's PIH Notice 2005-37. On or about page 93, immediately following PIH Notice 2005-37, we're going to go ahead and pick up again where we left off with disability expenses. We will give you a few seconds to turn to page 93. Our next deduction is disability assistance expenses. Disability assistance expenses are reasonable expenses that are anticipated for attendant care and auxiliary apparatus for a disabled family member that are necessary to enable a family member to be employed. The employed family member could be the person with disabilities. Let me give you two examples. I am employed and I have a 19-year-old son who is a person with disabilities. While I go to work, I need someone to watch my son. Is he eligible for child care? The answer is no, because he's too old. However, I can claim attendant care for my disabled son to enable me to go to work. This is considered a disability assistance expense. In my next example, I go to work and I am a hearing impaired individual. In order for me to go to work, I need special equipment for the phone. This equipment is an auxiliary apparatus that will enable me to go to work. So therefore, this is a disability assistance expense. If I work and my disabled son needs a wheelchair, is that considered a disability expense? The answer is no, because his wheelchair does not enable me to go to work. He needs a wheelchair regardless if I work or not. Once again, the disability assistance expense is allowed only if it enables a family member 18 years of age or older to be employed and is only allowable for attendant care or an auxiliary apparatus. This deduction may not exceed the earned income received by family members who are 18 years of age or older and who are able to work because of such attendant care or auxiliary apparatus. The allowable unreimbursed disability expenses is to the extent that the sum exceeds 3% of the annual income. If a family qualifies for both medical and disability expenses, that 3% threshold is only applied once. Our last deduction is child care expenses. Allowable child care expenses are amounts anticipated to be paid by the family for the care of any children under the age of 13. This includes foster children. This is the only deduction that a foster child is eligible to receive. So you as the PHA, you will determine what are reasonable child care expenses. As a PHA, it is your responsibility to determine what is reasonable. What is reasonable for in-home care versus daycare? If I drop my child off for 4 hours a day, do I get charged for half a day, or am I required to pay for a full day? You have to determine that through your PHA policy when you determine what is reasonable for your area. We're not going by what we think is reasonable. We want to do a little bit of market research regarding child care. Do not include any amounts paid for by a source outside of the family. Only the amount of out-of-pocket for the assisted family will be allowed as a deduction. And we're only going to include any child care expenses for any children under the age of 13 residing in that assisted unit. Reasonable child care expenses are allowed if they enable a family member to actively seek work, be gainfully employed, or to further their education. In the case of child care that's necessary for employment, the amount that's deducted cannot exceed the amount of employment income included in annual income. So keep in mind that if I'm receiving the benefit of the earned income disallowance, the child care is capped by the amount of income included in annual income, which is line 7F of the 50058, not gross income, shown in field 7D. We also need to prorate the expense when care is necessary for work and to attend school. For example, I work part-time and go to school part-time. Housing authorities need to determine which child care amounts are needed for school and which amounts are needed for work. I'm going to make it easy for myself. 50% of my child care is for school and 50% is for me to go to work. I pay $5,000 per year in child care, so $2,500 allows me to go to school and $2,500 allows me to go to work. The entire $2,500 I pay to enable me to go to school is allowable because there is no dollar cap on the expense. The $2,500 to enable me to go to work is capped by the amount of earned income included in annual income. My wages that are included in annual income is $2,000. Therefore, my child care expense that allows me to go to work would only be $2,000. The combined prorated child care deduction is $4,500. Because child care expenses are anticipated amounts to be paid, the cost may be different during specific times of the year. Think about when children are in school versus when they're out of school. When more than one family member is working, which one is enabled to work by the expense? That's PHA policy. We also need to prorate the expense when the family has both child care and disability assistance expenses. In this example, we have the head of household, a child who's 15 years of age and who is a person with disabilities, and then we have another child who's 8 years old. The head of household is working and needs care for both children. The attendant care is $3,000 per year. The child care is another $3,000 per year. Each expense is separate. However, the same earned income cannot be used for both expenses. The sum of both attendant care and child care cannot exceed the amount of employment income. While the earned income for this family is $5,000 per year. Therefore, the total of both attendant care and child care, which is $6,000, cannot exceed $5,000. It doesn't make a difference which allowance is calculated first. The deduction will come out the same. So you can use $3,000 for disability and $2,000 for child care, $2,500 and $2,500. It doesn't matter how you calculate it. The bottom line answer will remain the same. Let's do another walkthrough exercise together. we will use the information on page 94 to calculate the 50058 on page 95. John is 65 years old. He's the head of household. He receives a pension of $6,000 per year. His daughter, who's 35 years old, is working, earns $10,000 per year. She happens to be a person with disabilities and requires a specific type of wheelchair to enable her to go to work. It's going to cost her $1,800. John's grandchild, who's 10 years of age, is also in the home. The family pays child care costs of $2,400 per year, and the family's medical expenses are anticipated to be $1,785. Let's take this information and calculate their adjusted income on the following page. On line 8A, the form tells us to copy from 7I. Because we don't have a 7I for John, we're going to look at the previous page and look at the two types of income and add them together. We have John's pension and we also have his daughter's earnings. So on line 8A, let's put $16,000. And go to the next bold area because we're skipping over the permissible deductions. If the head, spouse, co-head is under 62 and no family member is disabled, skip to 8Q. Well, John is elderly and his daughter is a person with disabilities. So we're going to continue this calculation on 8F. On 8F, our medical and disability threshold, the form tells us to take 8A times 0.03. So let's take 16,000 times 0.03. 8F, we should have an answer of $480. On 8G, our next line, the total annual unreimbursed disability assistance expense. Well, remember, John's daughter needs a specific type of wheelchair to enable her to go to work. That's an auxiliary apparatus. So on 8G, that wheelchair is going to cost her $1,800. So 8G, go ahead and write your answer of $1,800. Next, let's calculate 8H. The form tells us 8G minus 8F. When we take $1,800 and subtract $480, do we get a positive or a negative number? We get a positive number, so we're going to put our answer on the first field of 8H. We should have an answer of $1,320. On 8I, this is asking for the earnings that are made possible by the expense. Well, John's daughter's the one who's going to work, and for her to go to work, that is what is enabling that expense. So her wages is $10,000. On 8I, write in $10,000. 8J is our allowable disability expense, and the form even tells us to take the lower of 8H or 8I. Our answer on 8H is $1,320. Not zero, not blank, we're using the field that has the answer in it. So we're going to compare 1,320 to $10,000, which is the lower amount. On AJ, we're going to put our answer of $1,320. Next, we have 8K, which is our unreimbursed medical expenses. The family's anticipated medical expenses will be $1,785, so let's go ahead and write that on line 8K. On 8M, this is the total for both disability and medical expenses, and the form tells us 8J plus 8K. So when we add up our answers on 8J and K, 1,320 plus $1,785, we will have an answer for 8M of $3,105. Next, we have 8N. We have another one of those split fields. The first one, if no disability assistance expenses, well, we have disability expenses. Or if 8G is less than 8F. Well, 8G is higher than 8F. So we know we're not going to use this first field because neither one of those statements applies. So look at the second field on 8N. If disability assistance expenses and 8G is greater than or equal to 8F. Well, that's a true statement. So the form tells us to copy from 8M. So the second field on 8N is $3,105. On 8P, John qualifies this family as an elderly family, so they get that $400 allowance. Next on 8Q, what is the total number of dependents that we have in this family? 2. We have a person with disabilities and we have a minor under the age of 18. So 8Q is 2. 8R is $480 per dependent. So on 8S, when we take 2 times 480, we get $960. Next we have 8T, the unreimbursed child care costs. We let you know that the child care costs will be $2,400 for the year. So on 8T, let's go ahead and write our answer of $2,400. Go ahead and finish the last 2 lines on your own. Calculate the total allowances for 8X and then the adjusted annual income on 8Y. On 8X, we have total allowances of $6,865. On 8Y, our adjusted annual income is $9,135. On the following 2 pages, you have another learning activity to be completed for Billy. Pause the video to complete the adjusted income learning activity. Billy is a person with disabilities who lives alone. There are no other persons in the household. With the information that we provided, we're going to go ahead and calculate Billy's adjusted income on the following page. Billy receives Social Security disability and he's also working part-time. His total annual income for line 8A is $16,640. This includes employment income of $10,640 that we're going to need to calculate his disability expense. Billy needs a hearing device for work that's going to cost him $380. Billy's medical expenses are as follows. He has health insurance through his employer. He pays $75 semi-monthly. So that would be $75 times 24 periods in the year. The annual prescription costs are $268. Let's go ahead and place this information on the 50058. On line 8A, we have an answer of $16,640. 8F, 3% of Billy's total annual income is $499. On 8G, the unreimbursed disability assistance expense is $380. On line 8H, if 8G minus 8F is positive, well, when we take $380 and subtract out $499, do we get a positive or a negative number? We get a negative number. So did you use the second or third field on line 8H? We use the third one. If negative and head, spouse, co-head is elderly or disabled, which Billy is disabled, we're going to copy from 8G. So on the third field of 8H, we should have an answer of $380. 8I, the earnings that are made possible by the disability expense, is $10,640. 8J, we're going to take the lower of 8H or 8I. So on 8J, we have an answer of $380. Next, we have 8K, and this is where we're going to put Billy's total annual unreimbursed medical expenses. We're going to take his insurance, which is $75 twice a month, which would be 75 times 24, and we're going to add the prescriptions of $268. So on line 8K, our total annual unreimbursed medical expenses is $2,068. 8M is asking for the total of both disability and medical expenses, and on 8M the form tells us to add 8J plus 8K. So 8M we have $2,448. Next on 8N, this is the total allowable medical and disability assistance expense. Did you use the first or the second field on 8N? We used the first one. The reason why is because 8G is less than 8F. So we're going to put 8M minus 8F. So on the first field of 8N, you should have an answer of $1,949. This family qualifies as a disabled family, so on 8P, we're going to give him the $400 allowance. There are no dependents. There is no child care. Our total allowances on 8X is $2,349. And the adjusted annual income on 8Y is $14,291. Go to the progressive learning activity and complete the adjusted income portion of the learning activity for the Martin family. So go ahead and pause the video to complete the learning activity, and the learning activity can be found on pages 190 and 191. We're building on the Martin family progressive learning activity. Let's go ahead and go over the answers for the Martin family's adjusted annual income. On line 8A, you should have an answer of $34,491. We got this answer from our previous page on 189 when we calculated the family's total annual income. We're going to skip over the permissible deductions and go right to line 8F. On 8F, we have $1,035. 8G is our total annual unreimbursed disability assistance expenses. This is for Marilyn. Marilyn is a person with disabilities, and to enable Mike to go to work, the family needs attendant care for their daughter Marilyn. Marilyn is too old to receive child care, so this expense would be listed under a disability assistance expense. Marilyn's attendant care is $125 bi-weekly, so we take 125 times 26 and have an answer for 8G of $3,250. On field 8H, did you use the first, second, or third field? We should have used the first field, and the first field on 8H is $2,215. On 8I, the earnings in 7D made possible by the disability assistance expense, this is Mike's wages, because in order for Mike to go to work, they need the attendant care. So on 8I, we have $20,280. On 8J, the form is telling us to take the lower of 8H or 8I, so we compare our two numbers, and on 8J, our answer is $2,215. On 8K, does this family qualify for medical expenses? The answer is yes, because the spouse, Marcy, is a person with disabilities, and she makes the family a disabled family. So on 8K, the total annual unreimbursed medical expenses is $5,029. How did we get the $5,029? We took their annual prescriptions of $600, plus we added the medical insurance premiums, $207 per month times 12 months. Marilyn's physical therapy, $35 per week, so 35 times 52 weeks, plus the co-payments for the family of $125 for the year. We add up the total medical expenses, and that's how we got our answer on 8K of $5,029. 8M is the total for both disability and medical expenses, and the form tells us to take 8J plus 8K, and our answer on 8M is $7,244. On 8N, did you use the first or second field? We should have used the second field, and on 8N, we're just going to bring down our answer from 8M of $7,244. 8P, we have a disabled family, so on 8P, they get the $400 allowance. On 8Q, how many dependents do we have? We have 3. We have 1 full-time student and 2 minor children. So 8Q, we have 3 dependents at $480 per dependent. So 8S, we have a dependent allowance of $1,440. Next, we have 8T, which is the child care costs. The family needs child care for Michelle, which is $50 per week. So on 8T, the total annual unreimbursed child care costs is $2,600. 8X, the total allowances for this family is $11,684. And on 8Y, their adjusted annual income figure is $22,807. Our next topic is TTP, Total Tenant Payment. This part of the lesson begins on or about page 99. TTP is a figure used to determine tenant rent for public housing and family share for the Housing Choice Voucher program. TTP is the highest of the following amounts: 30% of the family's monthly adjusted income, 10% of the family's monthly income, welfare rent, but only for as-paid localities, and your PHA's minimum rent figure. The PHA must charge a family no less than a minimum monthly rent that's established by your agency. The PHA may establish a minimum rent anywhere between $0 and $50. The PHA must grant an exemption from payment of minimum rent if the family is unable to pay the minimum rent because of a financial hardship. All PHAs must develop written policies to carry out such requirement. Your financial hardship includes the following situations. First of all, when the family has lost eligibility for or is awaiting an eligibility determination for federal, state, or local assistance program, including a family that includes a member who is a non-citizen lawfully admitted for permanent residence who would be entitled to public benefits but for Title IV of the Personal Responsibility and Work Opportunity Act of 1996. Other examples include when the family would be evicted because it is unable to pay your housing authority's minimum rent, or when the income of the family has decreased because of changed circumstances, including loss of employment. This even includes if the family members themselves voluntarily left their job. When a death has occurred in the family can request a financial hardship exemption, and then any other circumstances as determined by your housing authority or by HUD. Now, this first part is for public housing only. If a family requests a hardship exemption, the PHA must suspend that minimum rent requirement beginning the month following the family's request. The PHA will remove its minimum rent figure from the family's calculation. You will continue until the PHA determines whether there is a qualifying financial hardship. The PHA must then promptly determine whether a qualifying hardship exists and whether it's considered temporary or long-term. Your housing authority may not evict the family for non-payment of minimum rent during this 90-day period beginning the month following the family's request. If the PHA determines that the hardship is temporary, your PHA must reinstate that minimum rent from the beginning of the suspension period of that minimum rent. In other words, if the hardship is temporary, the PHA's minimum rent will continue to be in the tenant's calculation. However, if the family is unable to pay, your agency may not evict the family for non-payment of rent during this 90-day suspension period. At the end of the 90-day suspension period, the PHA must offer the family a reasonable repayment agreement for the amount of back minimum rent that's owed by the family. This next part is for housing choice vouchers only. If a family requests a hardship exemption, your PHA must suspend that minimum rent requirement beginning the month following the family's request. The PHA will remove its minimum rent figure from the TTP calculation, continuing until your agency determines whether there is a qualifying financial hardship. Your PHA must then promptly determine whether a qualifying hardship exists and whether you consider it to be temporary or long-term. If the PHA determines the hardship is temporary, the PHA must not impose the minimum rent during the 90-day period beginning the month following the family's request. At the end of the 90-day suspension period, your PHA must reinstate that minimum rent from the beginning and then offer the family a reasonable repayment agreement. There is only a slight difference between public housing and Section 8. In public housing, you are the landlord and the PHA. Therefore, the minimum rent can be charged, but the PHA cannot evict the family for non-payment of rent. In Section 8, we have a third party involved, the owner. So for the 90-day period, we have to remove the minimum rent requirement altogether. The following applies for both public housing and housing choice vouchers. If the PHA determines there is no qualifying hardship, the PHA must reinstate the minimum rent from the beginning of the suspension period, and the family must pay the back rent on the terms and conditions which are established by your housing authority. If your housing authority determines that the hardship is of long-term duration, you must now exempt the family from the minimum rent requirements. And this exemption goes back to the beginning of the month following the family's request and will continue until the hardship no longer exists and the family doesn't have to pay you back. It's time for another walkthrough exercise with Jenny. Jenny's annual income from 8A is $17,000. Her adjusted annual income from 8Y is $13,650, and this PHA's minimum rent figure is $25. So let's use this information and put it on the 50058 Part 9 total tenant payment on the following page. On line 9A, this is the total monthly income. The form tells us to take 8A and divide it by 12. 17,000 divided by 12 and then rounded will give us a figure of $1,417. 9C tells us to take 9A times 0.10. So $1,417 times 0.10 will give us $142 on line 9C. 9D is our adjusted monthly income. The form tells us to take 8Y and divide it by 12. $13,650 divided by 12 will give us an answer on 9D of $1,138. 9E, this is the percentage of adjusted monthly income. You'll notice that the form tells us to use 30% for Section 8. Well, we're going to use 30% for both programs for the purposes of this class. So on line 9E, the only thing we put there is 30. Not 0.30, not 30%, just 30. So your answer on 9E will always be 30. Then when we go to 9F, TTP, if based on adjusted annual income, the form tells us to take 9D times 9E and divide it by 100. So you can get your answer on 9F in one of two ways. Follow the format on the form, 1138 times 30 divided by 100. You should have an answer on 9F of $341. Now, a shortcut for those of you who do a lot of calculations, when we take $1,138, multiply it by 30%, we're going to get the same answer on 9F of 341. 9G is 0. 9H, this is your PHA's minimum rent. For this housing authority, their minimum rent happens to be $25. Next, we have the enhanced voucher minimum rent. We're not going to be doing any enhanced voucher calculations in this class. That's a whole separate day all by itself. So on line 9I, the enhanced voucher minimum rent, we're going to leave that blank. 9J, the TTP, the form tells us we're going to use the highest of lines 9C, 9F, 9G, 9H, or 9I. So which is the larger amount? On 9J, our TTP is $341. Your next field on 9K, this is the TTP from the previous 50058. I just happen to throw in a number, $318. What this figure is this is the TTP that your agency was using prior to this new calculation. So on 9K, I just went ahead and put 318. 9M, the form wants to know, does this family qualify for a minimum rent hardship exemption? Well, in this scenario for Jenny, no, they don't. So on 9M, our answer is N. It's time to go ahead and complete the progressive learning activity for the Martin family. Pause the video, go to the progressive learning activity, and complete the TTP portion of the learning activity, pages 192 and 193. Let's take a look at the TTP for the Martin family. On line 9A, you should have $2,874. 10% of monthly income on 9C is $287. On 9D, our adjusted monthly income is $1,901. 9E is 30. Remember, we're always going to put 30, only 30, not 30%, not 0.30. On 9F, 30% of adjusted monthly income is $570. Next, we have 9G. There is no welfare rent, so we're going to put 0. On 9H, the minimum rent for this PHA is $25, and we do not have any enhanced vouchers. So on line 9J, the TTP for the Martin family is $570. And then on line 9K, their most recent TTP was $538. And 9M, does this family qualify for a minimum rent hardship exemption? The answer is no. So let's go back to where we left off and talk about verifications for a while. Verifications begin on or about page 103. Think audit trail. First of all, you have the family's personal declaration completed for their initial eligibility, annual, or interim recertification. Next, you would generally have an interview or other form of contact with the family. As a PHA, we must verify what the family is certifying or recertifying. An auditor, supervisor, manager, or other staff person should be able to pick up any case file, review the case file, and know exactly what is happening with the family, the unit, the owner, or anything else that has to do with that file, without having to ask multiple questions of the individual who performed any functions relating to that file. The paper trail or audit trail, this is the beginning to any PHA review as well as any audit. Failure to verify and leave a clear audit trail can result in a poor score for your agency. Accurate determination of income, eligibility, allowances, and family rent can only occur with full verification of all factors related to the household income and family circumstances. The PHA must obtain third-party verification for any reported family income, the value of all assets, any expenses related to the deductions from annual income, and then any other factors that will affect the determination of adjusted income. HUD has a hierarchy of acceptable verifications. The first one is UIV, which is your upfront income verifications. Next, we have third-party written verification, then third-party oral verification, with review of documents provided by the family next, and our least preferred method is the family self-certification. HUD has implemented the use of upfront verification techniques to improve income verification and reduce the error rate in applicant and participant income reporting. This was one of HUD's initial attempts for improving income integrity. Upfront verification is considered third-party verification. Think about UIV as verification received electronically, verification obtained from a database of sorts. You have SWCAs, your state wage information collection agencies. Often part of the state's Department of Labor, are a source of employers and reported wages. SWCAs are required to share information with housing authorities on requests, but they may charge you a fee. Most housing authorities no longer use SWCA because of EIV, the Enterprise Income Verification System. Those who still use SWCA often run it parallel to EIV. Credit Bureau Association, your CBA credit reports. This is the credit profile which contains public record information. It has credit relationships, inquiries, and demographic information. Running a credit report can show debts being paid, and if someone claims zero income, you can inquire about how these debts are being paid. You also have the use of the work number. The work number is an automated service that provides controlled access to a national database of nearly 40 million employment and income records. Information can be provided to the PHA at no cost. Then you have EIV, the Enterprise Income Verification. EIV is HUD's verification system for wages, unemployment, and Social Security. EIV is responsible for collecting and processing W-4 data, wages, and unemployment benefits from the National Directory of New Hires database. EIV is also responsible for collecting and processing Social Security, SSI, and disability benefits from the Social Security Administration. EIV is responsible for logging and reporting of errors and discrepancies between tenants' reported income as shown on the 50058 and the actual reported wages. EIV is responsible for user administrative functions and logging of user activities and access to tenant information. EIV is a form of UIV, upfront income verification. UIV data is used to validate tenant-reported income. HUD provides PHAs guidance for projecting annual income when data is available. When UIV data is not substantially different than tenant-reported income, meaning the difference between tenant-reported income and UIV-reported income is less than $2,400 annually. If UIV data is less than tenant-reported income, use the tenant-provided documents to calculate anticipated income. If UIV data is greater than tenant-reported income, then use the UIV data, unless the tenant can provide your housing authority with acceptable documentation to verify that there was a change in circumstances. When UIV data is substantially different than tenant-reported income, if the tenant disputes UIV data, then your PHA must request written third-party verification from the discrepant source so that you can project annual income. Once the PHA has verified and validated the income discrepancy, the PHA should calculate the tenant retroactive rent that's due and initiate any repayment agreement and/or any other corrective action. Now, in order to protect any individual whose records are used in a matching program, no recipient agency, non-federal agency, or source agency may suspend, terminate, reduce, or make a final denial of any financial assistance or payment under a federal benefit program to such individual or take other adverse action against such individual as a result of information provided by such matching program until the agency has independently verified the information. And your UIV data can only be disclosed to the tenant. Now, under the UIV Data and the Privacy Act, what we're talking about here is that your PHA may not take any adverse action based solely on any upfront income verification data. You must obtain third-party verification if you intend on taking any adverse action, such as an overpayment recoupment and even termination of assistance. Next on our hierarchy is third-party verification, and third-party verification consists of written verification or oral verification from a reliable source. Written verification must not be hand-carried by the family. Your PHA can mail or fax the verification form to the verification source with a release form signed by the applicable family member. Third-party verification must go directly to the source and directly back to your housing authority. If the family brings in any type of third-party verification form, it's no longer considered third-party, and you're going to have to make a phone call to bring that third-party verification into compliance. Third-party oral is typically used when the PHA is unable to obtain written third-party verification. PHAs generally attempt 1 or 2 written contacts before going to an oral attempt. Housing authority staff would telephone the verification source and speak to a reliable individual to obtain the necessary information by asking questions and documenting the information received. If third-party verification is unavailable, the PHA must document in the case file why they were unsuccessful in obtaining third-party verification. If third-party verification is unavailable, your PHA may then use a review of documents provided by the family, such as pay stubs, bank statements, Social Security or any other award letters, and even receipts for expenses. Do not use bank statements as proof of income. What is deposited into an account is the net amount, and we must verify the gross amount. For asset income, don't use 1099s. 1099s provide income earned from the previous tax year and does not provide all the information that we need to determine the cash value and anticipated income for that account. When we use a review of documents, make sure that you get the originals. Avoid accepting photocopies. Copies can be altered, increasing potential fraud. And our least preferred method is family self-certification. Family self-certification should only be used when third party is not available and there are no other documents to be reviewed. And of course, you're going to want to document in the case file why you are using this type of verification. Other factors that you want to consider when a family reports zero income. When a family reports zero income, well-managed housing authorities enhance their interview with the family, and some even visit the family's home. The Public Housing Guidebook has a zero-income questionnaire to assist agencies in determining regular contributions. If the family has a car, telephone, cable TV, or has other evidence of expenditures, your agency should inquire about the source of income supporting cash expenditures. Many families are unaware that regular contributions to the household are considered income. Also keep in mind that a family may not have income included in their annual income, but can still meet their needs. A family may have income where all sources are excluded. For example, a family may have food stamps, foster care, and developmental disability care payments. The Public Housing Guidebook has dedicated an entire chapter to verifications, Chapter 7. Our first PIH notice of the year 2004, issued on March 9, 2004, provided housing authorities with verification guidance. This PIH notice is 36 pages. You can go to HUD's website to download this notice for additional guidance. We also had another notice issued back in 2006 on December 19th, PIH 2006-41. This notice provides guidance for obtaining verification of Social Security and SSI benefits. We have provided an outline in your book on page 107 with a copy of that notice directly behind page 107. Basically, this notice informs housing authorities that due to EIV, the Social Security Administration will no longer provide third-party verification to any housing authority free of charge. HUD says that housing authorities should request a benefit verification letter dated within 60 days from each household member who receives Social Security or SSI. The notice also provides examples on how to document a case file when your PHA cannot obtain the information through EIV. This is the end of the combined lesson for public housing and housing choice vouchers. The next DVD is for public housing tenant rent, and the final DVD is for housing choice voucher, family share, and subsidy.